You probably heard the word tariff a lot in the last couple of days. What does this exactly mean for you and me? This is what we're here to discuss today. Now, without getting into too much of the complexities of this tariff, essentially what it means is that there are going to be some fees and duties applied on import of goods and services into the United States. Now, because the tariffs imposed by Trump were quite high, which no one expected, so that would then mean that some of the companies that are operating inside of the US will no longer be able to import those goods or services from other countries where labor and materials are cheaper. This was done so that more of the business can be conducted within US. But the bottom line of that is that if the goods are manufactured and serviced within US, then costs are going to go up. If costs are going to go up for these companies, that would lead to reduction in profits. This is the theory anyway. Considering this theory, us as investors have started wondering if this is going to affect the profits, and therefore, out of fear, have started selling off the stocks that we hold. If we are all selling, that would lead to a reduction in the value of the shares. Now, if all of this is a little bit difficult for you to understand, I would highly recommend that you check out my previous video on this topic, which I will link at the end of this video and down in the description below. In that video, I go through the details of how the stock market works. So now let's come back to the question at hand. How is this going to affect you and me? If you are one of the people who have sold your shares, or are considering selling your shares, or were thinking about getting into the stock market or investing but have put brakes on it, here's what I'll tell you. If we look at this historical data, you can see that back in 1915, the stock market did really well, 81.49% of ROI for that year. The next year, however, was pretty bad, 4.19% down. The next year after that, 1917, was 21.71% down. Why do you think this happened? Some event took place in between 15 and 16, and then there was a downturn in the stock market. People then got scared, sold more shares, dropped it a lot more, and then people realized that the stock market was too low and started buying back in 1918. That's when the stock market went up 10.51%. And when the stock market went up by 10%, even more people thought that this was the time to invest and boosted the stock market up to 30.45% in 1919. Again, not only did the economic climate change, but also people started cashing out on their profit of the previous year, and 1920 saw a huge reduction in the share values by 32.9%. But the point is, we had a massive gain in 1915, went down, and then went up more than it went down. Again, went down by a lot, went up more than it went down. Went down again, and then skyrocketed up to 1928. The next few years, you can see, was a pretty bad time period for the stock markets. But then, if you come back, the increments after that between 1933 and 1936 was massive. So if we consider all these historical indicators, and if you go through the charts, you will see the same thing too. It's pretty obvious what we should all be doing. This is a time for us to not panic sell. This is not for short-term investments. Don't get me wrong, I'm not trying to say that the stock market is going to change overnight, it's going to skyrocket tomorrow, day after tomorrow. We are here for long-term investments. Short-term investments are for gamblers. Even if we look at the year 2020, when we all in our head think it was a year where we lost a lot of money, that's because the first few months, Jan, Feb, March, was a huge downturn. But then the market recovered, and by December, you can see that we actually had a positive of 7.25% in 2020 itself. The next few years were great. It was a huge bull run. And now, so far this year, we are on the downside again. By this, you should clearly be able to understand that this might probably be a great time for us to get back into the market. And even though it feels like such a huge drop off, if we look at the index, even though we were approaching 45,000 for a brief time, if you look at the long-term graph over the last 5 years, we were down at about 24,000 and we are still up at about 40,000. So the stock market has not really gone down by that much in the grand scheme of things. The last 5 years ROI is still above 66%. So this dip might be actually a blessing in disguise, where you have the opportunity to jump back in and get your investments back on track. Now click here if you'd like to learn a little bit more about the basics of stock markets. Please don't forget to hit the like button if you enjoyed this video. I'll catch you in the next one. Take care.